I had to ask you about something that I think every single person listening has felt at least once.
Mm.
You're looking at a market, maybe it's a tech stock that just won't quit, or I don't know, some obscure crypto with a dog on it.
Yeah.
You look at the price and then you look at the actual thing you're buying,
Mm-hmm.
and the math just doesn't work, like at all.
It's that moment where you're staring at the screen and thinking, has the entire world gone mad, or is it just me?
Exactly.
Yeah.
It feels like you're being gaslit.
Mm.
You see the earnings or the utility, and logic is screaming, this is overpriced!
But then you wake up the next morning and the price is up another 10%, and you start to feel like maybe you're the one who doesn't get it.
You're sitting there with your calculator while everyone else is, seemingly buying Lamborghinis.
Right. Well, that feeling is actually the perfect entry point for what we're covering today. We're doing a deep dive into a document called the Market Psychology Report. And we're going to unpack a specific framework that explains exactly why that happens. It's a concept that gets thrown around a lot, almost like an insult, but this report treats it as a serious economic theory, the greater fool theory.
It does sound a bit mean, doesn't it? Calling your fellow investors fools. But our mission today isn't to name call. It's to look under the hood.
Yeah.
We want to understand the mechanics of these moments. Why do bubbles inflate? What keeps them floating? And most importantly, what actually causes them to pop?
And to do that, we kind of have to put away the spreadsheets. This report makes it really clear. When you are in a greater fool scenario, standard financial analysis isn't just useless. It can actually be a liability. We aren't really talking about economics today. We are talking about belief systems.
Which is infinitely more complex. So, okay, let's get into the source material. Section 2 of this report defines the theory. But before we get there, maybe just how does a standard rational market work? If I buy a share of a company, what am I actually paying for?
So in a rational market, what we call a fundamental market price is driven by intrinsic value. If you buy a stock, you're buying a claim on future cash flows. You buy a house, you're paying for the land, the bricks, potential rent. The price is, anchored to reality. If the price gets too high compared to that value, people stop buying and it comes back down.
Okay, that makes sense. It's like a weighing machine. But the report says the greater fool theory operates on a completely different set of physics.
Completely different, yeah.
And-
The report defines it as a market state where the price of an asset is determined not by its intrinsic value, but entirely by the belief that there will always be another party willing to buy it from you at a higher price in the future.
So the asset itself, it doesn't matter. It could be a share of the world's best company, or it could be a pet rock.
In this specific psychological phase, the asset is just a vehicle. It's a token that lets you play the game. You're not buying it because you want to keep it. You're buying it because you're absolutely convinced that someone else, the greater fool, is waiting in line behind you to pay more.
So it basically becomes a game of high-stakes hot potato. I buy it for $10, not because it's worth 10, but because I think you'll pay me 20.
Precisely, and you'll pay 20 because you think someone else will pay 30. And the report's introduction highlights a key distinction here. It says that extreme market episodes, the huge run-ups and the sudden crashes, are almost never explained by fundamentals. They're explained by collective psychology. The market shifts from being a calculator to being a contest of anticipation.
That's a huge shift in mindset. I mean, if I'm investing based on fundamentals, I'm analyzing the business. But if I'm in a greater fool market, I'm analyzing other people.
You're analyzing the crowd. You're betting on their behavior, their greed, and specifically their liquidity. You're trying to guess how many people are left in line behind you.
Okay, so if this is a game of psychology, what are the rules? Section 3 of the report is titled Market Psychology Mechanism. It talks about what actually fuels this engine, because you need a lot of energy to keep a price rising when there's no real value holding it up.
The report identifies a few psychological drivers, but the most potent one is something it calls the logic of hype. And it brings up a term we all know, FOMO, or fear of missing out. But the report frames FOMO a bit differently than we usually hear it.
I mean, usually we think of FOMO as just jealousy. I see my neighbor making money, so I want in.
That's part of it. But the report suggests that in a greater fool market, FOMO acts as a validation mechanism. Think about it. If you're investing based on value, a rising price is a bad thing. It means the asset is getting expensive. You should wait.
Right. Buy low, sell high. If it's already gone up, I miss my chance.
Exactly. But in a greater fool scenario where the only value is someone else will pay more, a rising price proves the thesis is working. It proves the crowd is hungry. So when the price skyrockets, it doesn't signal expensive. It signals momentum.
So the higher it goes, the safer it feels to buy. That is completely backward.
It's backward to a value investor, for sure, but it is perfectly rational if you're playing the greater fool game. The rising price creates the narrative that the line of buyers is infinite.
And to keep that story going, we have to do some mental gymnastics. There was a phrase in the report that I was loved, something I usually hear when talking about sci-fi movies, not the stock market. Suspension of disbelief.
This is one of the most brilliant insights in the whole document. In a movie theater, suspension of disbelief is when you just accept that Superman can fly. Because, if you started arguing about physics, you wouldn't enjoy the movie. You voluntarily turn off your critical thinking.
Right. I know it's fake, but I choose to believe it for 2 hours so I can be entertained.
And the report argues that investors do the exact same thing during bubbles. You have smart people, doctors, engineers, hedge fund managers who look at a valuation that makes zero sense. They see a company with no revenue valued at billions. And instead of saying this is impossible, they suspend their disbelief.
They just turn off that critical part of their brain.
They willingly ignore the traditional metrics, the PE ratios, the debt levels, all of it, and they focus only on the price action. They tell themselves, oh, this time is different, or you just don't understand the new paradigm.
It's a willing blindness. Because if they acknowledge the math, they'd have to sell. And nobody wants to leave the party while the champagne is still flowing.
Exactly. The report notes that during this phase, valuation is just irrelevant. The only thing that matters is the story. It went up yesterday, so it'll go up today. That becomes the entire thesis.
But this feels so fragile. It's like Wile E. Coyote running off the cliff.
Yeah.
He's fine as long as he doesn't look down.
Yes.
The moment he looks down, the moment he engages critical thinking, he falls.
It is incredibly fragile. But the report suggests it's not totally random. You don't just have to guess when the coyote is going to look down. There are actually technical signs that the suspension of disbelief is starting to crack.
This is the part I really wanted to get to. Section 4 covers technical analysis. It talks about specific market phases called markup and distribution. Can we break those down? Because this seems like the difference between making a lot of money and losing your shirt.
It is the most practical part of the report. So markup is the phase we've just been describing. Hype is high, the narrative is strong, the price is moving vertically. This is where the public usually jumps in.
Okay. And distribution.
Distribution is the danger zone. This is when the smart money, the people who bought in way before the hype started, begin to sell their positions. But here's the trick. They can't just dump everything at once, or they would crash the price.
So they sell slowly.
They sell into the strength.
Yeah.
When the public is frantically buying because of FOMO, the smart money is quietly handing over their shares. They're distributing their holdings to the latecomers.
That sounds sneaky. How are we supposed to spot that? The price is still going up, right?
The price might still be going up, or maybe just moving sideways, but the report gives us a very specific red flag to watch for. A divergence between price and volume.
Okay, let's unpack that. Price is obvious, the dollar amount. What is volume in this context?
Volume is the number of shares or assets being traded. Think of volume as the fuel in the rocket. In a healthy rally, you want price going up and volume going up. That shows broad participation. It shows a lot of people are convinced.
Okay, so price up plus volume up equals a real rally.
Generally, yeah. But the report warns us to look for the divergence. This is when the price is still rising, maybe even hitting new highs, but the volume is starting to drop.
So the price is climbing, but fewer and fewer people are actually trading.
Exactly. Imagine a party. At 11 p.m., the dance floor is packed, the music is loud. That's high volume. But at 2 a.m., the music might be just as loud. That's the high price. But if you look around, the room is thinning out, the energy is gone.
And if you're just listening to the music, just watching the price ticker, you think the party is still raging. But if you looked at the volume, you'd realize the smart people have already called their Ubers.
That is the perfect analogy. When you see price rising on low volume, it means the enthusiasm supporting the price is hollow. It's a warning that the supply of greater fools, the new buyers you need, is running low.
And that concept, running low on fools, brings us to the inevitable conclusion. We've talked about the greater fool.
Yeah.
But Section 3 and Section 6 introduce the character nobody wants to be, the last fool.
The one left holding the bag.
Yeah. Now, I think most people assume bubbles burst because the price gets too high. Like there's some invisible ceiling where everyone collectively says, okay, $100 is too much for a tulip. But the report says that's not what triggers the crash.
No, and this is the most profound insight for me. Too high is totally subjective. If you've suspended your disbelief, no price is too high. Valuation doesn't pop bubbles. Exhaustion pops bubbles.
Exhaustion of what?
Exhaustion of buyers. The greater fool theory works like a pyramid scheme. To keep the price going up, you need an exponentially growing number of new buyers. But the population is finite. Eventually, you just run out of people who haven't bought yet.
It's purely a supply and demand issue.
Strictly supply and demand. When
Yeah.
the last interested buyer has bought, there is literally no one left to bid the price up. The buy side of the order book just evaporates.
And that's when gravity kicks in.
That's when the panic sets in. The report describes the result as a collapse. It doesn't use the word correction. A correction implies the price is adjusting to a fair value. A greater fool market collapses because the entire reason for owning the asset was the hope of a future buyer.
Right. If I'm holding this hot potato and I turn around to pass it to the next person and there is nobody there, the value of the potato just drops to zero.
Or to whatever the real intrinsic value is, which might be pennies. The reason for holding it just evaporates instantly. And because everyone realizes this at the exact same time, everyone rushes for the exit. But since there are no buyers, the door is welded shut.
That is a terrifying image. It's not just that you lose money, it's that you are stuck. You literally cannot sell.
And that is the moment the suspension of disbelief shatters. Reality rushes back in. You aren't looking at a chart anymore. You're looking at a catastrophic loss of wealth.
So bringing this back to the listener, we live in a world where these cycles seem to be happening faster and faster. Crypto, meme stocks, collectibles. Section 5 discusses implications for the investor. How does this report change the way we should look at risk?
It completely reframes risk. Traditional risk analysis asks, is this a good company or is this a solid asset? But this report says that in a momentum market, those questions are secondary. You can buy a terrible asset and make a fortune if you're not the last fool.
So the risk isn't about quality, it's about timing.
The risk is structural. The report argues the biggest risk is buying when the supply of next buyers has been exhausted. You need to stop looking at the asset and start looking at the structure of the market participants.
You have to ask, who is left to buy this?
Exactly. If your cab driver, your dentist, your grandmother, and everyone on your social media feed is already in, who is left to push the price higher?
That's the famous shoeshine boy indicator from the 1929 crash. When the shoeshine boy is giving you stock tips, the market is tapped out.
Not because shoeshine boys aren't smart, but because they represent the late majority. When the last person hears about the opportunity, well, the opportunity is over. There's no fresh capital left.
That leads nicely into Section 6, the conclusion. It has a bit of a philosophical take on this. It says the greater fool theory isn't about individual stupidity.
I think this is so important. It's easy to look back at the dot-com bubble or the 2008 housing crash and say, wow, those people were idiots. But the report argues this is a structure of market psychology. It's systemic.
So it's not that I'm a fool for getting caught up in the hype. It's that the market itself creates a psychological current that is very, very hard to swim against.
We're social animals. We are wired to follow the herd because for thousands of years, leaving the herd meant you got eaten by a lion. In financial markets, following the herd feels safe, even when the herd is running straight off a cliff. The structure of the market rewards participation until it punishes it.
So if it's structural, does that mean we can navigate it? Or is the lesson here to just hide our money under a mattress?
You can navigate it, but you have to change your mindset. You stop judging the market as irrational and start seeing it as just a mechanism of liquidity. You can participate in the markup phase. You can ride the wave.
But you have to know you're surfing, not building a foundation.
Right. You keep one eye on the volume. You keep one eye on the exit. And you never, ever believe your own hype. You respect the narrative because it drives the price, but you don't marry it.
I think that's the aha moment for me. I always thought about investing as me versus the stock. Is this stock good or bad? But this report is saying in these scenarios, it's really me versus the flow.
That is the shift. You're analyzing the river, not the water. Is the current strong? Is it drying up? That's what matters.
Let's do a quick recap of what we've uncovered in this deep dive, because we've covered some serious ground. We started with the uncomfortable reality that price does not always equal value.
Right. In a greater fool scenario, price is simply a measure of belief in the existence of a future buyer.
We talked about the suspension of disbelief, how we all collectively agree to ignore the math because the story of rising prices is just too compelling to check.
And we identified the warning signs. Specifically, that deadly divergence where prices keep rising but the volume starts to fade, that's the signal the smart money is handing the bag over.
And finally, the sobering reality of the last fool. Bubbles don't burst because of valuation, they burst because of exhaustion. When the music stops, it stops fast.
It's a cycle as old as trade itself. From Dutch tulips in the 1600s to South Sea stocks in the 1700s to whatever is trending on Reddit today. The assets change, but the software running in our brains, fear, greed, and that hope that someone else will handle the risk, that hasn't been updated.
It really makes you look at those parabolic charts differently. Instead of just seeing potential profit, you start asking, okay, who is on the other side of this trade?
And that is the most valuable question an investor can ask. Am I the smart money or am I the exit liquidity?
Before we sign off, I want to leave our listeners with a final thought to chew on. We've talked about how to avoid being the last fool. We've talked about spotting the warning signs. But there is a strategic question here.
Go on.
If we accept that this is a game of musical chairs where the music will inevitably stop, is it actually possible to consistently win? Or is the markup phase designed in such a way that the vast majority of us are just destined to be the supply for someone else?
That is the ultimate question. The report suggests that while the game is structurally rigged against the latecomer, the individual who understands the rules, who watches the volume, who ignores the hype, they can survive.
So it's not about not playing. It's about knowing that you are playing.
Exactly. Know the game you're in.
Something to think about the next time you see a chart going vertical and feel that little itch to click buy. Check the volume, check your suspension of disbelief, and ask yourself, do I see the exit?
Stay sharp out there.
Thanks for diving deep with us today. We'll catch you on the next one.